that we have now. So if you want to take notes, you can see there on Moodle, and we will start. So we have been talking on topic 2. We talked about information for decision making, and last week we had some examples on types of information. So we talked about cost, volume, profit analysis, so the break-even point, margin of safety. We talked about operating leverage. We did several examples on that. You also have some exercises on Moodle to practice. We talked about relevant costs, relevant revenues, and then we will be using these concepts to look at specific types of decisions. So we have their special pricing decisions, outsourcing and make or buy decisions, discontinuation decisions, and product mix decisions. So we talked a little bit about this last week, but today we will go deeper on which of these kind of decisions, and we will see how we can make decisions for these examples, through examples on each of these kind of decisions. So you can read more on this on the chapter 3 from the book. And let's keep going here. Just to remind you, it's important when we're making decisions that we have into account both the benefits and costs. Okay, so we talked about this last week, and you know these just to keep in mind. Okay, so we want to keep consider what are the benefits, okay, for each decision that we make, what are the benefits of that decision, and what are the costs associated with that decision. So what resources do I need to use in order to go forward with that decision? And we also mention about relevant. What is relevant? Okay, so please remember the concept of relevant. So there was 3 conditions we talked about last week. So it has to do with future. Okay, it has to be different between different alternatives. Okay, so if it is the same, if we decide to sell between a pink or a blue shirt, and the selling price is the same, and we sell the same quantities, it's not relevant, the color, right? So only when it is different between the 2 alternatives, then it is relevant. And also it must have an impact on cash flows. Okay, so we have these 3 conditions for a revenue or cost to be relevant. Now, we will now move forward to special pricing decisions. So let's look at this example. So I will ask you on today's class, we have a lot of examples. So please make sure that you have pen and pencil with you and you take note. It's really important, also a calculator, so that you can try to solve and get the numbers. And I will be asking the numbers throughout today's class. So make sure that you're ready, you have your calculator, your pen, pencil with you, and you're ready to answer with the results. Okay, so let's look at this example. So we have here a special pricing decision. So this is for a short-term order. So company X has offered to buy 120 seats at a ticket price of 250 euros per passenger to an airline company in a flight to Macau, where normal ticket price is 450 euros and total cost per passenger is 300 euros. Okay, so we have here an airline, and this airline had received an offer from company X for 120 seats, and they are only offering to pay 250 euros. So the price of 250 euros. We normally, if we are the airline, we normally sell these tickets at 450 euros. And the total cost per passenger is 300 euros. Now, the unit variable cost is 40 euros, which refers to meals and beverage. Okay? And then we have the question, should the airline company accept this special order? Now, the objective for the airline is to maximize profit in the short term without affecting the long-term profit. So, what do you guys think? Should they accept this order or not? Anyone wants to turn on the mic or write there on the chat?
Sorry, I have a few questions. So in this example, the company X offers to buy for 250 and the airline usually offers them for 450. The total cost per passenger is 300. So the question is, should they offer it, but should they do it? But 250 is lower than 300. So I don't really understand your question.
Okay, so we have another piece of information, which is the variable cost. The unit variable cost is 40 euros. Okay, so the 300 is the total cost, which includes both fixed and variable. And then we have that the unit variable cost is 40 euros. There's this.
No, this doesn't help. So they offer to pay 250 per passenger, and they will get 300. They spend 300 themselves, and then on top of that, the company also pays 40 for meals and beverage. So 290 versus 300. Is that the question, or?
So the 250 is the selling price for this special company, okay, for company X.
Mm-hmm.
They normally sell the ticket at 450, so they are offering a selling price of 200 euros less than market price. The total cost, which includes both fixed and variable, is 300 euros. And we have a variable cost out of the 300, 40 euros is variable. That means that the remaining is fixed costs.
So the company X would have to pay 290 per person.
How do you get to the 290?
No, I mean, is that what you mean with the variable cost, that the company, so they pay 250 for the tickets and then they pay 40 on top for meals and beverages during the flight?
No. So 250 for if we are in the shoes of the airline, they receive, if they accept the order, they receive 250 from the client, company X.
Mm-hmm.
And the airline incurs in variable costs 40 euros with meals and beverages, and the remaining 300 minus 40 is fixed costs, depreciation,
Okay.
Employees, etc. of the airplane.
Can I try to answer the question?
Yes.
So I would say that this opportunity, the company should not accept this opportunity, because from my calculations, if each passenger pays 250, the total revenue will end up being 30,000, and that is not even enough to cover the fixed costs, which are 31,200 euros. So it doesn't make sense, I think.
Okay, thank you.
Can I also give my opinion?
Yes.
I think they should accept, because it says here in a tricky way that the cost is 300, but the fixed costs are already happening, whether they have passengers or not. So the only thing that you should care about is variable costs, and they clearly cover it. So if they can have people buying their seats at 450, they should. But if those seats were already left empty, then they should accept it, because it's better than not having anything.
Okay, so this is the point. Okay, so I see also here on the chat some people say that no, they should not accept. So what is the company has to look here? So we have, for the company that they have this option to sell. Now they have to consider in terms of capacity. So we have the flight to Macau. If we can sell the tickets at 450, we should do that. We should not sell them by 250, obviously. But if we have the flight to Macau and the Macau has empty seats, and we cannot do anything else with those empty seats, then receiving the 250 is better than fly and not have this revenue. So we have what we have here in terms of to look at in terms of relevant costs and revenues. So between accepting or not accepting the order, this special offer. So if we accept, we have relevant revenues. So what changes? So compared to the option of not accepting, we will have extra revenues of 250 euros times 150 seats. And if we accept these, we also incur in extra costs, relevant costs, which are the variable costs. If we do not have these seats, so if we do not have these people flying, they will not use meals and beverage. So we will only spend money with meals and beverage, so the variable costs, if they fly. So the relevant cost that we have here by accepting this order is the 40 euros times the 220, the 126. Okay? So we have here the difference between these relevant revenues and these relevant costs is 24,000 in terms of profit. And we can have this extra 24,000 if the company has excess capacity. If they do not have excess capacity, then they would have to consider the opportunity cost, and the opportunity cost would be not selling the tickets at 450. So obviously that would be not a good option. So if we have this initialized capacity, we must compare the price with the variable costs. Okay? If there is no excess capacity, we also have to take into account the opportunity cost of not selling the tickets at the market price of 450. So as I was just mentioning, so we have that the relevant costs exceed the relevant revenues are higher than the relevant costs, and therefore we should accept the order. We should only accept this order if we can have the following assumptions, if you can guarantee the following assumptions, meaning that it's not because we sell these tickets at 250 that it will imply the normal market selling price of 450. And if we do not have any other better opportunities during that period, and if we cannot use the resources like the empty seats for something else, let's imagine instead of having people sitting there, we could ship cargo and we could have a better use of the space. And the fixed costs are unavoidable, meaning that we are going to fly to Macau no matter what. If the flight is full or not, we will fly, so we will incur in the fixed costs, and therefore it's better to accept this special order. Questions on these? So it might seem a little bit counterintuitive at first when you look at it. So that is why the concepts of relevant costs and relevant revenues is important, because at first we will think, no, we should not accept this. We have total cost of 300 and they're only paying 250. So this is the first thought that we have. But when we think about it, if we do not have a use for the capacity, then we think, okay, maybe it's better to sell by 250 than not selling at all. Okay, as long as that does not affect the normal selling price of 450. Questions here?
Yes, I have one question about total fixed cost. Shouldn't we measure?
I'm sorry, I cannot understand you. Can you speak louder?
Yeah, okay. Can you hear me?
Yes, now it's better.
Okay. So I'm wondering about the total fixed cost.
Mm-hmm.
Can we measure in relation to the seats, to the total seats, and not per passenger?
No, the 300 here is per passenger.
But this accounts for the unit variable cost plus the total fixed cost, right?
So the 300 will be will have a component of fixed cost and a component of variable cost. The component of variable cost is 40 euros.
I mean, but if we fly a plane and we have some total fixed costs, if passengers are 10, the total fees cost divided by the passengers will be higher
Okay. So
than if
when
we
we
have 20 passengers.
when we calculate this total cost per passenger, which includes the fixed costs, it's if we look at the total capacity of the aircraft. Okay, let's imagine the aircraft has 300 seats. So the 300 seats, so we have these fixed costs and variable costs, and all of the costs by passenger, which considering the capacity in terms of seats of the aircraft, gives this unit cost.
Okay.
Obviously, if we are not using the whole capacity, the fixed costs per passenger will be higher.
Yeah. Okay. Okay. Yeah.
Okay.
Thank you.
More questions? No? So let's see these other examples. We have here an example of a product mix decision with capacity constraints. So we have scarce resources. So when we have scarce resources, so capacity constraints, we do not have capacity for all the demand, this restricts the output. And when we have this limited capacity, the objective for the organization is to concentrate, to focus production or to focus the activity on those products or services that yield the highest contribution margin per scarce resource. Okay, so remember this, engrave this in your mind. Contribution margin per scarce resource. So let's look at this example. So we have here a law firm which is in a very busy moment and needs to prioritize work for next month. As capacity for the period is restricted to 280 days, which cases must be accepted? So they have three types of cases. They have civil, criminal, and family cases. We have here the contribution per case. So the contribution, you remember the concept of contribution margin, which is related with sales revenues minus the variable costs. So you have here the contribution per case. We have the days per case in average. So for a civil case, it gives a contribution of 1,000 euros, and we spend 4 days to solve the case. We have the demand for each type of cases, So we have a demand of 25 for civil, 15 for criminal, and 14 for family. And therefore, we have how much days we require to satisfy all the demands. So this 100 is just 4 days per case times the 25 cases that we have in terms of demand. So given that 100, if we sum the required, is 100 plus 120 plus 140, is higher than the capacity because we only have 200 days available, 280 days available. So we do not have capacity to supply or to satisfy all the demand. So we have to choose which cases we must accept. Okay? In order to do this, what we have to do is, as I just said before, is to look at the contribution margin per scarce resource. So this is what I want you to calculate now. So calculate there what is the contribution margin per scarce resource. Let me know what would be the offering or the focus of the company for the period. Okay, so how many cases of civil, how many cases of criminal, how many cases of family they should be doing for the next month. So use your calculator there and let me know what will be the cases for next period. You already have someone?
I think I have an idea.
Okay.
So when we compare the contribution per case, we can see that family is the one that contributes more. Mm-hmm. So first we take it, and it takes 140 days. So next we go to the criminal, and it's left 20 days So out of that 20 days, we will accept only 5Ks of the civil. You understand what I'm saying?
Yeah, I'm following what you're saying,
Yeah.
but I think you forgot about what I just mentioned before. Anyone sees the flaw there?
Can I try?
Yeah.
Okay.
No, you go.
So, thank you. So basically, we wanted to calculate the contribution margin per day. So basically, the scarce resource here would be the number of days.
Exactly.
So I would go with contribution per case divided by days per case. And we can see that the civil will have a contribution margin per case or per day of 250 euros.
Mhm.
The criminal would be 187, and then family would be 200. So I would fill up the 280 days with first civil cases,
Mhm.
then I would go with family, and the rest will go with criminal.
Exactly, and that is also what Margarida wrote there in the chat. And Frederick, also civil plus family, and the remaining two criminal. So this again is a little bit tricky. So we have to pay attention to this special part of what is relevant, okay? Because we have limited capacity. So at first we would think, yeah, okay, family gives higher contribution, so we should go for family. But then when we think about, okay, but family takes 10 days, right? And therefore, if we divide by 2000 by 10 days, I mean, for civil, it only takes 4 days. So if I look per day, I should be doing civil because in 10 days I can do and earn more if I do civil cases than if I do family cases. And then it's the same reasoning for criminal. So when we have limited capacity, we should be looking at this contribution per scarce resource. And when we do this is exactly what you said, okay? We will first fill in the civil, that will be the 25 cases. Then we should fill in with the family cases, and we are left over with 40 hours. And with these 40 hours, we can do 40 days. And with these 40 days, we can do 5 criminal cases. So what is then the profit if we do this, if we follow this ranking of the cases and having into account fixed cost of 35,500?
25K.
25,000, exactly. Very good. So there's two ways to go about it to very quickly calculate the profit. Either we multiply the contribution per case times the number of cases, or when we calculate the contribution per scarce resource, so for civil, it would be 250 times the number of days, and we take the 100 days, so 250 times 100 days. For family, it would be 200 times the 140 days. And for criminal, it would be the 40 days times the 187.5. So this either way would give the same profit, okay, minus the fixed costs. So again, to calculate the profit here is important to remind the concept of contribution, which is revenues minus variable costs, right? To get the profit is revenues minus variable minus fixed costs. So very quickly we can calculate the profit in this type of exercises. Very good. Any questions?
Sorry, I didn't understand how you calculate the variable cost in this case.
The variable costs is already included in the contribution. The contribution is the revenues minus the variable costs. So when we have there for civil 1,000 euros, the contribution per case of 1,000 euros, those 1,000 euros include the sales revenues for one case of civil minus the variable costs of one case of civil.
Okay, so it will just be the 25K of civil plus the 28K of family less the fixed cost?
So to calculate the profit, we could calculate, yes, so the 25,000 for civil, and the same, we will do for family and also for criminal, taking into account the 5 cases, okay, minus then the fixed costs.
Okay, thank you.
Yep. More questions?
I'm sorry, can you explain again the days? So why we're doing the 25 civil cases,
Mm-hmm.
so all the available cases, and then the 15 of criminal, but then
No, that we do the 25, so for civil, what we did was to calculate the contribution per scarce resource, okay? So when we calculate the contribution per scarce resource, we do that for civil. To calculate that, we do 1,000 euros divided by the number of days, divided by 4. So we know how, because the scarce resource is the number of days, because we are limited for 280 days and our demand is higher than the 200 that we have available. So that is our scarce resource, the number of days. So for each type of service, we will calculate the contribution per scarce resource, the number of days in this example. So for civil would be 1,000 euros divided by 4. For criminal would be 1,500 divided by 8. And for family would be 2,000 euros divided by 10. Then we will compare how much is the contribution margin per scarce resource. And we will see that for civil will be 250 euros. For criminal will be 187.5 euros. And for family will be 200 euros. So this 200 euros is contribution margin per case per day. Okay, so each day that they work in these type of cases, this is how much they have of contribution margin. Based on this, we see that civil, which is the contribution margin per case per day, is 250. We should work on that first, okay, because it gives us a higher contribution margin per scarce resource. So we will be doing all of the 25 cases of civil, and then that will take up 100 days. We have 280 days available. Then the remaining, so we are left over with 180 days. The next one is family, which gives a contribution margin of 200 per case per day. And if we have time enough to fulfill all of the demand. So to 100 days for civil, 140 days for family, we have 280 days available, means that we are left over with 40 days available, and we will be using these 40 days that we have available on the criminal cases, which is the one that gives us the lowest contribution margin per case per day. Okay? With these 40 days, if we divide by 8 days that we take in each case, it means that we can do 5 cases with these 40 days. I don't know if this answers the question.
yes, and then to calculate the profit, we just compute the contribution per case times the number of cases that we will do of each, and then subtract the 35,500, right?
Exactly.
So the contribution is already the difference between the price, and the variable costs.
And the variable costs, exactly. Okay.
Thank you.
That is one way to go about to calculate the profit. As I was mentioning, there's another way to calculate the profit. So we can either calculate the contribution margin per case and multiply by the number of cases, or because we just calculated the contribution margin per case per day, we can also use that. So we could also multiply, for instance, for civil, it would be 250 euros per day times the number of days times 100 days. And then for family, it would be the 200 euros times 140 days. And then for criminal, it would be the 40 days times 187.5 euros. Okay, but both ways is will give the same result. Okay, and you can just choose which one you think is more logical. More questions?
Sorry, here we don't need to subtract the fixed costs.
Yes, we still need to subtract
okay.
the fixed costs. Okay, we always need to do that to get the profit. Otherwise, what we get is just the contribution margin in total. Okay, in both cases, we have to subtract fixed costs. Good point. More questions?
Sorry, what was the profit value in the end?
Was 25,000 euros.
Okay, thanks.
More questions? No? So let's move forward to the next type of decision, which is decisions on replacement of equipment. So the original purchase cost of the old machine, so it's when we want to buy a new machine, for instance, a new equipment, or its written down value and depreciation are irrelevant for decision making. So this is what we need to keep in mind when taking this type of decision. So now we have here this example with information. So the written down value of the existing machine with a remaining life of 3 years is 90,000. So this is the value that we have on the balance sheet in the asset of the machine. And then we are considering to purchase a new machine. The cost of purchasing the new machine is 70,000 euros. And it has an expected life of 3 years and 0 scrap value. So this is important because the remaining, the expected life is comparable, is the same for both cases. And this needs to be the case when we want to make this kind of comparisons, okay? Otherwise, we have to consider the scrap value. Then we have the variable operating costs both for the old machine and for the new machine. So how much it costs producing. We see that with the new machine, it's more efficient. So it only costs to produce 2 euros per unit, while with the old machine, it costs 3 euros to produce each unit. So we have here a written down value questions on the chat is the book value. Yeah, so the written down value is what we have there in the balance sheet. Yeah. And then we have the output of both machines is also the same. So they have the same capacity of production, which is to 20,000 units per year. And we have that if we want to sell the old machine now, we can receive 40,000 euros. Okay? So we can sell the machine, the old machine today, and we can receive 40,000 euros for that. And we have that disposal value of the old and the new machine in 3 years' time is 0. And then we have the question if we should replace or not the old machine with the new machine. So based on this information, what is your opinion? Based on calculations, on numbers.
I think we shouldn't replace it.
Okay, why?
Because if we replace, although we have a sell price of the old one of 40,000, we will buy the new one for 70,000, and the difference in the operating costs are only like 20,000. So the difference between the sell price and the buy price is not covering the difference in operating costs.
Mm-hmm. So that's a good point. But now we have to consider what is the period that we are looking at. So you're looking at the period of 1 year, right?
So
okay, we need to multiply by 3 years. Okay.
So if we consider the period of 3 years, what happens?
Yeah, actually, I would replace, because when I put all into account the disposal value of the old machine, the costs and operating costs for the 3 years, we would gain with a new machine by having a total cost of 190,000, because it's the 70,000 of the costs plus the 20,000 units times the amount per unit times the 3 years.
Mhm.
And on the other one, I consider the 20,000 times the €3 per unit times the 3 years. And I also added the kind of cost of opportunity cost that we get from not selling the old machine, and it would have a cost of 220,000. And in that sense, I would replace the old machine.
So how much is the difference between the two options of replacing or not replacing the machine?
30,000.
30,000. Okay, good. And we have Frederick saying that we can save 20,000 per year on units, so 60,000 for the 3 years. We sell for 40,000. Total value of replacement is 100, but the new purchase is only 70,000, meaning that we have 30,000 of savings exactly. So if we replace the machine, the old machine, by the new machine, we have here these 30,000 euros or euros of savings. Okay, so here on this example, we want to be looking at the time period. Okay, so not just looking at what happens right now. Right now, I will incur in a cost, but I have to look at the effects during that this investment will have during the period. So we have here the period of 3 years, because both machines will only be working for 3 years. So if we keep the old machine, it only works 3 extra years. And if we buy the new machine, it also only works 3 years. So during this period of 3 years, we want to be looking at what will be the impact on the costs that the company will incur. So, and obviously, and all of you consider that the written down value is irrelevant. So we only look at what will change in the future. So in the future, what changes if we purchase the new machine? We have a cost of 70,000, but if we purchase the new machine, we can sell the old one, so we will have a revenue or a minus cost of 40,000. So 70 minus 40. And then we will be saving in the terms of variable operating costs, because the new machine is cheaper. And you'll be having these savings for 3 years, okay? So, and therefore we have these 30,000 savings for the total if we purchase the new machine. Very well done. Questions? So I have here a question. We don't have data available, but if we had, should we do not consider the difference in saving taxes due to depreciation? So depreciation, we do not have information. So depreciation is irrelevant. Okay. We could include in terms of taxes, right? That would probably change because they have different values. No, we do not have that information, but it would be relevant. It would be relevant, yes. We have,
Sorry.
yes.
Professor, here we don't include the fact that the written down value is 90,000, but yet we sell it for 40,000. Don't we have to include that in the calculations in a way as well?
I'm sorry.
So the written down value in the books is 90,000. You sell it for 40,000. Isn't that in a way a loss of 50,000?
Mm-hmm. So
we don't add it in our calculations.
What you wanted to add in the calculations?
No, I mean in the books it's written that the machine is worth 90,000, sorry, and you sell it for 40,000.
Mm-hmm.
That means that in your book you will have a deficit of 50,000, right?
Yeah.
So if we add it to our calculations, then it's not worth selling.
But notice that the written down value, that is just an accounting value. It's not.
But it's still an asset of the company, right? So you're selling something below the value of your asset.
Mm-hmm.
Yes, if you can use it for 3 more years and then it's scrap metal, at least you don't lose the 90,000 at once.
It's not a relevant cost. It's a past cost that it's irrelevant.
But it shouldn't be, because it depends on a decision.
Yeah, I understood that we saw in investments that if it's like, it won't influence the decision we make now in terms of which money we make, but it will have an effect on our balance sheet.
Yeah, but that doesn't matter for management accounting, I think, because that's like for external information. We want information for the managers. That doesn't matter.
Exactly. Very good point there, Eduard. So, what we want to look at, what is relevant, if you remember, we want to measure those relevant costs and revenues, and these are the ones that imply cash flow and imply the future. Okay, so what we have done in the past is irrelevant for this specific decision. So,
but this is not. Sorry, I don't get it. Because this is not the past, this is the future. If I sell, something's going to happen, right? Mm-hmm. If I sell, my assets are going to be down by 50,000.
Mm-hmm.
So,
so it's a capital loss, meaning it's a non-cash flow expense. So it doesn't impact the cash flow.
But you have to incur this 50,000 somewhere, right? I mean, that's a loss you have to put in somewhere, right?
I just think that the book value of an asset is different from the market value, because, for instance, if a new version of the machine that you bought in the past, probably because the new machine appeared, it will affect the market price of the old one that you bought. So there you have the difference between the book value and the market value. And when you actually sell the old machine, you will sell it for the market price of it and not the book value of it, I think.
So what we're discussing is the difference in terms of what we have in the books. Okay, so yes, in the books there will be a change with the old machine. If we sell the old machine, that will change the books, but that will not. These 50,000 will not have any cash flow impact. The cash flow impact that we have is the 40,000, and that is what we should be taking into account in terms of the decision making. Okay, so for the decision making, what we have to look is what will happen in the future, what will be different between the alternatives, and what will imply a cash flow. Okay, so what we have, the value that we have, the book value, the written down value of the machine in the balance sheet, that and the depreciation, that is irrelevant. Okay, for the decision making, it will not change. It will not change if we buy or not the machine. It will not change cash flow if we buy the new machine or keep the old machine. The cash flow of the 90, it will not bring any cash flow. The 90,000. Okay, what will bring a cash flow is the 40,000. Okay, because if we sell the old machine in terms of cash flow, the impact is the 40,000. Okay, is it clear? Anyone wants to comment further on this? No, so let me just check what we have here on the chat. So Frederick saying about installation time of the new machine. Yep, that would be also an opportunity cost. So, but what company can go around this is to in order to minimize is to keep the old machine running while the new machine is being installed and then dispose. But normally this is like 1 day or so, if at all. Then we have Yannick. So we always calculate without discounting the values because we compare the values from different years. So obviously this is a very simplified example. Okay, so this is just the introduction, like in managerial accounting. Obviously, we should be, if we want to be more precise, we should be looking at the present value of the 3 years. Okay, so that is a good point, but this is just a very, very basic example to understand the concept behind it. Okay. Any more questions? No, everyone's ready to move to the next example? Yep. So let's look at this example of outsourcing. So if you should make or buy a component. So when we are talking about outsourcing, it involves obtaining resources or services from an outside supplier instead of producing them in-house. So let's have here this example that a company manufactures component alpha. And the cost of producing these 400 units is a total cost of 12,800. So we have direct materials of 4 euros per unit. We have variable conversion costs of 16 euros. Do you remember what are conversion costs? Anyone remembers from last week?
The costs that were necessary to convert into the final product.
Which includes what types of costs? We have there, Frederick, direct labor plus manufacturing overheads, okay? All of them are manufacturing, is the overhead. So we have prime costs, direct materials plus direct labor, and then we have conversion costs, which is direct labor plus overheads, manufacturing overheads. And then we have fixed conversion cost of 4,800. Now, there's the possibility of purchasing these 400 units, so it's the same quantity of units, from an outside supplier at the total cost of 10,000. What is the best decision if there's no alternative use for the capacity?
So the fixed conversation costs stay the same. So then you would pay 14,800. So yes, it would be better to do it yourself.
Exactly. Okay. So this is again where the trick is. So we cannot compare the 10,000 with the 12,800 directly, right? So if we buy outside, what's the total cost if we outsource? Well, if we outsource, we will incur in the 10,000 that we pay to the supplier, but we still have to keep the fixed costs because they are fixed. And that would be 4,800, where if we sum is 14,800 if we outsource. And this 14,800 that compares with the 12,800. Okay? And looking at this, we obviously want to produce in-house because it's cheaper than outsourcing. Very good. So now let's look at the other option. So instead of producing the 400 units of alpha, the company buys them from the supplier, but can use the capacity to produce 200 units of beta with a contribution of 30 euros per unit. So if they have this option of outsourcing at a cost of 10,000 and still use the capacity to produce beta, what would be the best option?
Then I think that the fixed conversion costs would be assigned to beta and therefore not directly impacting the costs of alpha. And so now we would have direct materials and variable conversion costs, which are assigned to alpha of 9,000, right? Yeah. No, 8,000. And so I would say that it still doesn't make sense to go for the outsourcing.
I disagree.
Yeah, I'm not sure I followed what you mentioned. So notice that if we produce beta, we will produce 200 units of beta, and these 200 units generate contribution of 30 euros per unit.
They should outsource, of course, because if they make, the cost will be 12,800. If they buy, the cost would be the 14 and 800 minus the contribution margin, that is 6,000. So they would be better off.
Okay. So now what is the difference when we have this second option of producing beta is that to the cost that we have if we outsource, and if we outsource, we will incur in 10,000, we'll incur in the fixed cost 4,800, but then we will have extra revenues or a contribution from beta valued at, as the colleague was saying, 30 times 200. So that will be minus because it's a contribution. So it will be a minus cost. And therefore, if we do this, we will have a total of costs minus the contribution of 8,800, which we will compare with the 12,800. So you have there on the chat some people saying that we should outsource. Exactly. Was this one clear? Any questions on this one?
Yeah, I was just wondering, could we use the whiteboard again? Because sometimes it's hard to follow if something happens with the internet and gets cut off. And now I don't. Is this possible like last time?
We can use the with whiteboard. We have this transition time between whiteboard and the slides because then I have to go back to the slides. But for this one, do you need me to write on the whiteboard or is it okay?
Yeah, this one, yeah, please. Because my internet got cut off and I lost the middle of it. And now I don't know.
So let me go to the whiteboard. Okay, can you see the whiteboard?
Yes.
Yep. Okay. So if we outsource, so this is, do you want for question A or only for question B?
Only B, thanks.
Okay, so for question B, if we outsource, if we outsource, we will have, we will consider the costs of outsourcing, we will consider the fixed costs, and we will consider the contribution from beta. Okay, so the cost of outsourcing is 10,000, right? The fixed costs are 4,800. And the contribution, if we are looking at cost, the contribution of beta is a minus cost because it's positive, right? So if you look at costs, the cost of outsourcing, the fixed costs, the contribution from beta is a minus cost, is a contribution. So it's revenues minus variable cost. So that is a positive, is a minus cost, and that is 200 units of beta that we sell, and they have a contribution per unit of 30. And therefore, this gives a total cost equal to 8,800. And we will compare the 8,800 with the cost of producing in-house equal to 12,800. And because 8,800 is lower than 12,800, we will prefer to have lower costs, and that is to outsource and produce beta. Okay?
Perfect, thanks.
Good. So let's go back to the slides.
So, Professor, in that case, we are not using the variable cost for the 200 units we produce?
Yes, we are. So the contribution, remember, contribution is from the contribution margin. The contribution includes revenues, sales revenues minus variable costs. Okay.
Okay.
So those
Okay.
30 euros is selling price per unit of beta minus the variable cost per unit of beta. Okay.
Okay, thank you.
More questions? Oops. Any more questions here? No? So let's move to the next example. So now we have a discontinuation decision. So companies, they will look at different business units and they will try to see what is the profitability of each business unit, each product, and they will want to see if something is unprofitable, maybe they will discontinue. Okay? So those activities that are not profitable, that bring a loss to the company, they should be discontinued in order not to harm further the profitability of the total business. Now we have this company on the example. On this company, we have 3 territories. So we have Southern, Northern, and Central. And then we have there the total sales. So we have the sales for each territory and then the total sales, which is just the sum of them. We have the variable costs and the fixed costs. And then we have profit and loss. So we have that Southern has a profit, yields a profit of £168,000. Northern yields a profit of £154,000. And Central yields a loss of £56,000. So we have total profit of £266,000. Now assume that the special study indicates that, so obviously we see that Central has a loss. So what would be the first decision that we should make based on this table? So Central has a loss, we should discontinue Central, right? So this is the first thing that we think about, just looking at this information. Now let's look at the information that we have below the table. So assume that the study indicates that we can 250 of central fixed costs and all variable costs are avoidable. So we have fixed costs of 358,000. So out of the 358,000 fixed costs, we can avoid 250,000. That means that the remaining 108 fixed costs, they are unavoidable. Okay, even if we discontinue this territory. So now the question is if we should or not discontinue Central. Based on this information, if we should or not discontinue Central, what do you guys think?
No.
No, why?
Because the contribution margin of Central is 302 and the available costs are the fixed costs are 250,000. So if we discontinue, we are going to the contribution margin is bigger than the available costs. So we should continue to.
But if we shouldn't we consider the time, because now we have a loss of 56, right? And if we discontinue, we'll lose 108,000. But if we have a loss of 56 for 10 years, maybe it's worth discontinuing, right? Okay. Doesn't like the period matter for our decision?
So this is a good point. So you're remembering when I talked about the relevant range, right? Yeah. So when I talked about the relevant range, I said, we have fixed costs. They are fixed only for the relevant range. So for the short term, like in the long term, fixed costs, they are all variable. So this is a very good point. So here at this exercise, what we do not have information in terms of for how long we can not avoid this fixed cost of 108. What we have information is that the 108, these are unavoidable. Maybe they will be avoidable in 2 or 3 or 5 years. We do not have that information. So if we had that information, we could have a better decision. Okay, so, but just looking at now, with the information that we have available on the example, is that these are unavoidable. So we will incur in them. Okay, so, but that is a very good point. That is a very good point.
I would say that as long as the loss is smaller than avoidable fixed costs, they should keep they should continue with central.
Okay, anyone else? So you have here Frederick on the chat saying that, okay, it's the same thing that Gonçalo just mentioned. The loss that we have is smaller than the fixed costs that are unavoidable. So the incremental loss, if we discontinue, is 52 exactly. Anyone else wants to comment? Anyone? Beatriz? No. Okay. So if we discontinue central, what happens is that we will not have sales, we will not have variable costs, so those two items go to zero, but we will keep fixed costs in the amount of 108,000. If we keep central, and that would give us a loss of 108,000. If we keep central, the loss is just 56,000. So obviously, if we keep central, we have a lower loss. We have a loss, but it's lower than if we discontinue central. So in this sense, we should not discontinue. Very good. Any questions on this? No questions? Everyone's ready to move to the next one? So this here is the solution. So here is looking at the total impact on the total profit, the impact of keep central or discontinue central. So we see there in the profit, we have this difference of 52,000. So if we discontinue central, we have a lower profit than if we keep central open with a difference of 52,000. Now let's look at direct materials. So to get the relevant cost of direct materials, we have different cases. So if the direct material is required to produce, and we have to buy that, we do not have that material, we have to purchase the material, then the cost of this material will be the purchasing price, okay? And obviously, if we incur in transportation costs or purchasing costs extra to the purchasing price. So that will be the relevant cost if we do not have it in stock. If we have the material in stock, but this material is being used in other products, in other activities, then the relevant cost for the material will be the replacement cost. Because if the material is being used, if I use it, I have to replace the stock so that I can still use in other activities. Otherwise, someone will kill me if I not replace the stock. So the relevant cost is the replacement cost, which normally is also the purchasing price. If you replace, we have to purchase, but is the replacement cost. If we have the materials in stock, but the stock that has no use, so it's just because previously I bought in excess, I have the materials in stock and I don't use these materials, so the relevant cost of the material will be the opportunity cost. So if I have the extra materials in stock, what would be the best alternative? If I could sell the material, would be the selling, the realizable value of selling the material. So I could sell in the second-hand market, for instance. or if it is a material that no one wants to buy, that even have to pay the containers to come and pick up the material, we would have like a cost, like a double cost, because the cost, it's a cost that we will incur with the cost, so it will be a double cost. If we use it, we will be saving, okay? If we have to pay to get rid of the materials, and if we use the materials for the production of a product, I will be saving of not having to pay to get rid of the materials. So the relevant cost, if we have the material in stock and we do not use this stock, is the opportunity cost, which can be the realizable value if I can sell it in the second-hand market, or can be the savings from someone coming to pick up those materials from the inventory warehouse. Now, so let's look now at this example. So we have here 4 materials, A, B, C, and D. And to produce a product, we require these units of the material. So we require 2,000 units of A, 2,000 units of B, 1,000 units of C, and 500 units of D. For A, we do not have any units in stock. For B, we require 2,000 units and we have 1,200 units in stock. For C, we require 1,000 units, we have 700 in stock. And for D, we require 500 units, and we have 500 units in stock. So let's see what they're saying there for each material. So material B is used regularly and the stock must be replaced. Material C and D in stock are from past purchase excesses. Material C has no further alternative use, but material D can be used to replace material X, which is regularly used in other activities at a current cost of 7.50. And they are asking what is the cost of the direct materials if we accept this order. So if we accept this order, which requires all of these materials, what is the total cost with materials? So for material A, we require 2,000 units. We do not have it in stock, so the cost with material A will be the 2,000 units times what we have to purchase, so the purchasing price. So I will write here on the chat, which is easier. So for material A, we require 2,000 units, and it is at 6 euros per unit. For material B, we require 2,000 units. We have 1,200 in stock. We bought the 1,200 at 3 euros per unit. If we want to sell, we can sell them at 3.50. And if you want to purchase new units of B, we have to pay 5 euros. So what is the cost for material B? Who can help here? So, and material B is regularly used and the stock must be replaced.
Does that mean we can't just buy 800 units? Do we have to buy like 1,200 again?
So we need 2,000. So we have 1,200 in stock. So the 800 we have to purchase, right?
Yeah.
Okay, so this is clear for everyone. We have to purchase, and if we purchase, it costs.
But what does it mean that the stock must be replaced?
The stock must be replaced. It means that we have the 1,000 in the warehouse, but it's being used. These materials, they are used in the production of something else. Okay, so if we use these that we have now in the warehouse, we will need to replace. We will need to put back in stock.
So we can't just buy 800, right?
Sorry?
We can't just buy 800. We have to buy more. So we have to buy 2,000.
Exactly. So So because we have to replace the 1,200 that are in stock, we cannot just buy the 800. So the 800 is what we need to buy for the order, specifically for the order. But because the 1,200 that we have in stock, we have to replace, we also have to buy to replace. So that means that for material B, it will be the 2,000 units that we need times the purchasing price of 5. Does it make sense for everyone? So we have here on the chat, Yannick saying that the 800 is times 5, but still we need the 1,1200. And Frederick saying that 8,000 times 5. Yeah, but those, the original purchase price, if we have these units in stock, the original purchase price, when we bought them in the past, what kind of cost is it? If it's relevant or irrelevant? So we bought these 1,200 units. We have them in stock. These units will be used for in the normal production of other products. When we bought them at a price of 3 euros per unit. Okay, but these 3 euros is a past cost. We incurred that already in the past. So because it's a cost that we incurred in the past, is irrelevant. So on these kind of exercises, we have that the original purchasing price, just to bring confusion because it's irrelevant. We only want to look at the future. Okay, so in terms of the decision making, the original purchasing price is irrelevant. So what we have to consider here is that, okay, we need 2,000. We have 1,200 in stock. Okay, so for the 2,000, the first 800 I have to purchase, okay, and I will purchase at 5 euros per unit. Now the remaining 1,200, let me see what I can do with that, and we will do that for all other materials, okay, for B, C, and D. So for the 1,200, well, the 1,200, because it's used regularly and I must replace the stock, it means that I cannot just use the units like that. So I can use the units, but I have to replace them. And when I replace them, I will purchase them and I will pay 5 euros because to purchase them, I have to incur in the purchasing price of 5 euros per unit. And that is why it's the same as having 2,000 times the 5 euros. Okay?
Sorry, can I ask a question about that?
Yes.
I'm not sure if this is contributing to Frederic's question, but what is about that you would record expenses for materials cost only in the period, like in the, when you sell it? So wouldn't I only realize the costs when I sell the materials? So realize the 1,200 for the purchase price.
We do not sell the materials, okay? So
all right, we're just okay. Sorry.
It's in stock, okay? So what we sell is the final product. The materials, we have them in stock in the warehouse. It's an asset in the balance sheet, okay? And we have this asset there in the balance sheet. So we have 1,200 times 3. We have this in the balance sheet as in the inventory, but we have them in inventory. But the costs that I incur in the past will be irrelevant, will not imply anything in the terms of future cash flows. Okay, what it will imply in terms of future cash flows is what I will have to buy to replace this. Okay, and when I buy the 1,200 to replace the existing 1,200 that I already have, I will purchase them at 5 euros per unit.
Thank you.
Okay, let me try to understand Frederick's last comment. So in CDP analysis, we did consider present stock, not only new purchases. It is Is it because the question is framed as a decision-making question? Frederick, do you want to turn on your mic to ask? Because I'm not following your question.
Yes, I can do that. Can you hear me?
Yep.
Great. So what I meant was, I think it was last week when we're doing the CVP analysis, like to get the total cost of manufacturing the product, we would also take into account what the price of the current stock was and the price of the new stock in order to estimate like what the raw materials consumed to make the product was.
Okay. So you mean when we did those, you're talking about when you did the calculations for the cost of goods manufactured and the cost of goods sold?
Yes.
Now with the diagram with the truck leaving the warehouse.
Yes. Sure.
Okay.
Yes.
Okay, so it's different. Okay. So what you were doing back there was to calculate the cost of goods manufactured. Okay. So that is the objective there. Now, and that was about the past. Okay, when we calculate the cost of goods manufactured, we will see what are the costs that we incurred to produce. So to produce these many units, we used these materials, we used this much labor, and we used this much overheads. Okay, and we do the difference with what we had in the beginning of opening inventory and what we were left over at the closing inventory, and we do this. So when we do that, we are looking at what happened in terms of costs that we incurred there. Now, if we look at the question, it's different, it's framed differently. So the company has received an order which requires the materials. And then in the last line, what is the cost of the materials if the order is accepted? So we did not produce yet. Okay, we just had the client coming to saying, no, I want you to produce these, and they probably ask, how much does it cost? Okay, and for us, the company that will be producing, we will see, okay, so if you want to produce this product, we will incur in cost. So let's see how much cost we will incur in order to tell the client the costs at the price of this special order. Okay. So now we are looking at materials. So if you want to produce this for the client that came to us, we'll say how much materials we will be spending, okay? How much materials we will be consuming. But we have not used the materials yet, okay? So we are still in the decision of accepting or not the order, okay? Of choosing to do or not the order. In order to make this decision, we will be looking at the resources that we will be using. So this is before the manufacturing. So before the manufacturing process starts, I will make the decision of doing or not this order. And I will say, okay, in order for me to decide if I should do or not the order, let me calculate how much will be the cost of producing. And I will use the same reasoning as I used to calculate the cost of goods manufactured. But now we are only looking at materials, and we know how much materials we will use for this order. And to see how much it will cost in terms of materials, we will see, okay, so what will be the cost for each of the materials? So for material A, I don't have this material. I have to purchase the material. So the cost of material A will be the purchasing price. For material B, I need 2,000, but I have 1,200 in stock. Okay, so if I need 2,000, okay, I have to purchase the 800. So I will purchase the 800 at €5 per unit. And I have 1,200. So let me understand what is this 1,000, why I have this 1,200 in stock, and if they are being used. Okay, so then I read, okay, material B is used regularly and the stock must be replaced. Okay, so if it is used regularly, I have this in stock, but someone else is using for the production of another product, it means that I have to replace the stock. That means that, Okay, if I can use this 1,200, but I have to buy the 1,200 to put back in stock. Then if I have to buy them, it will be the cost will be 5 euros. Okay? I will only need to replace this stock if I accept the order. If I don't accept the order for the other product they already produced, they will be using the units that they have in stock. Okay? If I accept the order, you see, I have to purchase these units. Otherwise, I don't need to purchase them. Does it make sense?
Yes, I think I understand now. Thank you.
Okay, good. Then we have, let's go to material C. Material C will require 1,000 units, and we have in stock 700. So for material C, we require 1,000, we have 700. That means that for the 300, we have to purchase at 3,000, at 3 euros. So for the 300 that we have to purchase at 3 euros, let's see now about the 700, what they say about 700. So they say that material C has no further alternative use. Okay, so it was bought from a past purchase excess and it has no further alternative use. So we have to think about the opportunity cost. Okay, so for the 700, for C, as Madalena mentioned and Frederick as well, so for the 300 will be times 3. Now for the 700, we have to consider the opportunity cost. So the best alternative for the 700 that we have, what is it? So what are the alternatives that we have for the 700?
Reselling the materials for 150 per unit. So
Exactly.
you count 150 for the 700 you had?
So I can either keep the stock there in the warehouse with dust and occupying space, or I can sell it at 150. So the best alternative, instead of getting dust or sell, the best alternative is to sell and get 150. So then the cost of the opportunity cost of the 700 will be 150. So the total cost for material C, as Frederick is just mentioning, is 300 times 3 plus 700 times 150. Very good. So Joaquin is not minus, so you have to plus to sum both of them. Okay, so it's the cost of the 300 plus the cost of the 700. Okay, is it clear for everyone? Material C? Yep. So let's now go to material D. So material D, we need 500 units and we have 500 units in stock. What do they say? That the material D can be used to replace material X, which is used regularly in other activities at the current cost of 550. Okay, so for material D, we have it in stock, all of the units that we need, and it can have different alternatives. So one alternative that we have for material D is that we can sell it in the second-hand market at 5 euros. So the realizable value if sold is 5 euros for D. I can sell it by 5 euros. Or I can use it to replace material X, and material X costs 750. Okay? So what is the best?
Sorry.
Yeah, go on.
Yeah, I was just wondering if we use it for another material, why should we sell it, right? Is there
So let's think about what would be the best. So is it best to sell or is it best to replace?
Okay, but if we sold, we would have to buy it again, right? To use it for material X.
No, we material X. So we have material D is what we need for this special order. So and this material we have two options. We can, if we don't use it in this special order, the amount that we have in stock, we can either sell it
Yeah,
or
okay,
we
got
can
it.
use it to replace.
Yeah.
Now we have to decide what is the best alternative for the organization. So if we were in the organization, which option should we choose, to sell or to replace? Given the information that we have, if we sell, we get €5. If we replace, we save €7.50. So what is the best option?
Replace.
To replace. But it could be different. Let's imagine that we could sell for 8, and if we replace the material, the replacement was $7.50. We would prefer to sell and purchase material X at $7.50. Okay, but in this specific example, for the alternative uses of material D, the best option, so the opportunity cost, remember the definition of opportunity cost is the best alternative given up. So the best alternative given up would be to replace material X, and that would mean that we would stop saving $7.50 times the 500 units. So the cost of material D would be the 500 units times the 7.50. Okay, so this would be the cost of material D. So the total cost of materials.
Sorry, Professor. Shouldn't it be 750 minus 5? Because we're still having like some profit, or not? Because it's the difference of the two opportunity costs.
No.
At least that's what I thought.
No, is the opportunity cost is the best alternative given up. Okay?
Okay.
So
Yeah.
I can choose one or the other. I have different uses for material D. If I use the material D in this order, in this special order, I will give up doing something with material D. And the best alternative for material D, if I was not using in this special order, would be to replace material X. If I
but then you're not. Forget it.
Sorry? I can ask?
No, it's fine. Sorry.
If I use material D to replace material X, I will not purchase material X. Okay, so I will be saving 750 times 500. Okay?
Yeah, thank you.
So when we look at opportunity cost, is the best alternative given up. Okay, so we do not mix the different alternatives. So the total cost, anyone already calculated the total cost?
27,700.
27,700, excellent. Any questions? No? Okay, let's just finish with direct labor. So we will go a little bit later for the break, okay, and then we will return later for the second class, okay?
Professor, I got a question. Yeah. I think it's a quick one. It's regarding the last slide.
Okay.
So regarding material B, why don't we have to account the realizable value? It's because the material is used regularly.
Okay, so let's see what they say there below the table. They say material B is used regularly and the stock must be replaced. So for material B, it's not just sitting there. Like material C and D, we have them in stock from past purchase excesses. But material B, we have it there because we use it normally. Okay, so it's different. It's a different nature of the stock.
There isn't any opportunity cost.
Exactly. For material B, is not an excess purchase. It's not just sitting there in the warehouse doing nothing. Material B we use it normally in the production. And if we want to use it for this order, we have to replace the stock. For materials C and D, we don't normally use in the production. For C, it has no further alternative use, so we can just sell it because it's just sitting there getting dust. And for material D, we can either sell it or we can use it to replace another material, okay? But it's not the same. We can use it to replace another material. And we saw that in this example, the best alternative was actually to replace than to sell it because we would be saving more. Okay. More questions on this? No. So let's just go back to the relevant costs of direct labor. So just a couple slides more. Then we go to the break, and then we have half an hour break, and we return to the second part of the class. So determining the cost of direct labor. So we have also three options. So if the company has temporary excess capacity, so we have the employees there doing nothing, and we are paying the employees are just doing nothing. If we use these employees to do a special order, the relevant cost is zero because we are already paying the employees. Second option, if the company uses casual labor, means that the labor is a variable cost. So we hire the employees based on the need, on the demand. So in this case, the relevant cost is equal to the cost of the labor. And if the company is working at full capacity, and there's the reduction of existing production for if a specific order is accepted, means that okay, if I'm working at full capacity and if I want to accept this order, I have to stop producing something else, then the relevant cost of the labor will be the cost of the labor, so the hourly labor rate, plus the opportunity cost. What is this opportunity cost? Is the contribution margin lost from what I stop producing. Okay? So if I'm at full capacity, I have my employees are working on something else. If I want to accept a new order, the employees have to stop working in something else because they are stopping working in something else. I will lose the contribution margin of this something else that they will stop producing, and that will be also included in the relevant cost of labor for this special order. So let's look at the example. So we have this company that has to decide if it accepts a new project with a duration of 1 year and requires 4 specialized workers. These workers can be hired outside the company at an annual cost of 6,000 euros per worker. The supervision of these workers will be done by a manager who works already at the company and earns 90,000 euros per year. The new project requires 10% of the manager's time. Alternatively, the company can train the existing workers, each earning 45,000 per year. The total training cost is 22,500 euros. If these employees are assigned to the new project, they will have to be replaced by others at a total cost of 150,000. So what is the relevant cost with labor on this new project? So we have two options. Either we hire new specialized workers or we use the workers that we have and we train them. And these will imply also to hire other workers at 150. So what is the best alternative, and therefore what is the relevant cost with labor? Who wants to go first?
maybe hire new specialized workers, assuming that the manager is a non-relevant cost. If we hire the specialized workers, the cost would be 240,000, and if we train, we needed. Oh no! I think it's equal.
Mhm.
Sorry, I don't know. I'm a little
So
bit.
what is the cost if they subcontract the specialized workers?
240.
So it will be 4 specialized workers, so 4 times 60,000, 240,000. How about the cost of the supervisor? Is it
Yeah,
relevant or not?
yeah, I thought it should, because if the 90,000 alone, not, but the 10% should be accounted for, right? Because if we don't hire them, that manager is going to spend that time doing something else.
Well, we don't have information that will be stopped doing something else, right?
Yeah, he can have spare time, so.
Exactly. So maybe it's just sitting there, in this
That's
10% of his time, doing nothing, because it doesn't say
weird.
that he will stop doing something.
Yeah, but then how can we read the exercise and know that, right? Because I would read it and think that he should be doing something, or else it's not relevant to be there, that it requires 10% of its time.
Okay, so and this is really important, because as you were talking, I just remember about a master's student who was doing the dissertation, the work project with the company, and last semester. And actually, this is interesting because she was mentioning that it was a problem that they had in the company. So the company was acquired by foreign multinational. And so it's a Portuguese, they have the factory here in Portugal. It was acquired by the multinational. And the multinational changed the way of working. But they did not change the workforce. So they have the same managers. So in terms of the management, they have the same managers, but the same managers, because of the changes in the working way that the multinational requires, means that they have to work much more. But they didn't take that into account. So the managers kind of feel, unfair, and they feel overloaded because we were acquired, we are working much more, we have much more responsibilities. And this is interesting because what happens in companies that we not always have the full information. And this is just like this example. We don't have full information. So we are assuming that he's doing nothing, but maybe he's doing something and he will feel overloaded. But we don't have that information. So this is an excellent point, not just in terms of the example, but it really happens in real life. That we don't have full information about things and we will be making assumptions. So we will consider, now we are considering that now he's doing nothing and therefore is irrelevant. That if he's doing nothing on this 10% of the time, then he can just supervise these employees because he would be on Facebook or Instagram on this time. And then there's no extra cost. Now, if we had information, the manager, if he wants to supervise these specialized workers, he will stop supervising someone else, and if someone else, because they stop having the supervision from the manager, they incur into costs like inefficiency costs of 3,000, then we would consider this, okay? But we do not have that information. But it is an excellent point. I'm not saying, one is better than the other. It is just what happens in reality. And people have to make choices on the assumptions that they take. But this is really good. And if you want, if you're in final exam and you don't know, this is unclear, is ambiguous, you can write an assumption. I assume that manager is doing nothing, or I assume that manager is doing something else, and because he's doing something else, he will stop doing that and will be doing this. But notice, if you go back to the previous slide, in terms of relevant cost of labor, if we have temporary spare capacity, so if the manager is doing nothing, the relevant cost is 0. Now, if we will hire 10% of the manager's time, okay, the manager is working full time, he's busy, but because we ask the manager to work 10% on this special order, so the manager will work over hours, okay, extra hours, and we will pay the manager these extra hours. In that case, we would consider these extra hours, okay? If the manager is working in something else and he will stop working in something else, we will consider this 10% of the hours plus the opportunity cost, which will be how much is lost because the manager stopped doing something else. Okay? So it depends on the assumptions. Now,
sorry.
Yes.
In the last example, it's really quick. In the last thing you said, we should only consider the opportunity cost because you would win the same, right? So if he stopped doing something to do another thing, the cost will only be the person we would have to hire to do his job.
No, we still, in terms of relevant costs, we still need to include, we have to include both the salary correspondent to the time, okay, that he's working, plus the opportunity cost.
Yeah, but that doesn't change. The salary is the same. It just started working 1 hour per week on something else or whatever.
But that cost will now go to this product instead of going to the other product.
Okay.
Okay. More questions? So for the first option, which is to hire the specialized workers, it will be the 240 euros. For the second option, which is to train the existing workers, what is the cost? What is the relevant cost of the second option of training the existing workers?
I think it should be the 22,500 and the 150.
And the 150,000, exactly. So if we choose the second option, the relevant cost will be the cost of training, 22,500, plus the ones that we have to replace, to hire to replace, 150. So that is 172,500. Okay. Yep. Any questions? No? So now just last example before the break. We have that Smart Toys manufactures a variety of toys and games. The CEO, Johan Smart, is disappointed with the sales of the new board game. The game sold only 10,000 units in 2020 when 30,000 were projected. Sales for 2021 look no better. At £100 per game, it is not a hot seller. Direct costs of the board game are £56 of variable cost and 100,000 of fixed costs. And Johan is considering several options. So the first option is to cut the price to 70. So instead of selling at 100, to sell at 70 and perhaps sell 15,000 units. The option 2 is to cut the price to 60, reduce the material costs by 10, and cut advertising costs by 60,000. And this would give a volume of 10,000 units. And option 3 would be to cut the price to 80, include a £10 mail-in rebate offer, and it is anticipated that this could sell 15,000 units. and only 30% of the rebate coupons would be redeemed. So what would be the profit for each option? So if they choose option 1, what is the profit? And if they choose the other options, also what is the profit of each option?
So for option 1, we have to make the selling price 70 minus the variable cost 56, multiply this by 15,000 units, and we get 210,000.
Profit? You're forgetting something on the profit.
Yeah, we have to subtract the fixed costs.
Exactly. So that would give us a profit of
110,000.
110,000. Very good. Then for option 2, we would cut the price and we would also cut in materials and advertising. Advertising is like fixed cost, okay?
So variable cost would be 46, fixed cost would be 40,000, and you would do 60 times, 14 times 10,000 minus 40,000. So that's 100,000, I guess.
100,000. So that would be 60 minus 46 times the 10,000 minus 40,000 of fixed costs, 100,000. Very good. And Frederick is getting the right answers there on the chat. Very good. And now for option 3, the price would be 80 and it will include a 10 million rebate offer, and only 30% of these rebate coupons would be used.
Well, then you sell 70% of that 1,500 at the price of 80, and then the other 30% you sell at 70, and then you take the fixed costs.
How much would that give us? So the profit for option 3 would be so in terms of fixed costs would remain the same.
The option 3 with taking into account the fixed cost would be 215,000.
How much? Sorry?
215,000.
215,000, exactly. So it would be the 80 minus the 56 minus this 30% of 10 euros. Or we can do like the colleague just mentioned, and we will multiply this by the 15,000 units, and then we will deduct the 100,000 of fixed costs. Not sure if Frederick is also going to write option 3 on the chat or not, or should I write it down? So let me write it down. So option 3 would be 80 minus 56. Okay, Frederick already done that. Okay, wonderful. Great. Any questions?
Sorry, I have a question, but regarding the previous example.
So let's go back.
The final relevant costs are the 22,500 plus the 150 and the and also the 60 from 60 times 4 from the workers.
Okay, so here we on this example, so they are asking to calculate the relevant cost of direct labor. So here we have two options for the direct labor. We calculated the cost, the relevant cost of the two options. For the first option of subcontracting the specialized workers, we calculated the 4 times 60,000, which was 240,000. And the second option, which was to train the existing workers, the relevant cost was the 22,500 plus 150. By comparing the two options, we realized that is best or is cheaper for the company if they train the existing workers, because that would be 172,500 and the other one is 240,000. So the relevant cost for the project will imply that we did this comparison and we choose the best alternative, and that would be 172,500.
Okay, thank you.
That would be the final answer. More questions before the break? No? No more questions? Okay, so we will go to the break. So half an hour break. We will be back in half an hour, and then we will continue with this topic 2, with transfer pricing. Okay, so enjoy your break, and we will see each other in half an hour. Okay, everyone, good afternoon. Welcome back to the second part of the class. Is everyone there? Or is anyone there?
Yes.
Yeah, okay, good. Oh, wonderful. So let's now continue with the second part of the class. So we will now talk about transfer pricing. Okay, so we will first talk about responsibility centers and then move towards transfer pricing methods. So you can read on these on chapters 12 and 13 from the book. So the objective is to define the different types of responsibility centers, to discuss the advantages and disadvantages of divisionalization. So we also want to understand what is this divisionalization, and then to understand the different transfer pricing methods. So responsibility centers. What is a responsibility center? It is a unit of a firm. So when we look at the firm, it's a unit of the firm in which we have an individual manager that is responsible for that unit's performance. Okay? So when we think about, let's imagine a large organization, we can, for instance, an organization that we have in the shopping malls with different stores, in different shopping malls. So maybe each store will have its own manager. So each store in each shopping mall will have the store manager, and therefore we can say that each store is a responsibility center. Okay, so it's a unit of the business for which we have a person, a manager that is responsible for the performance of that unit. Why do we have responsibility centers? Because for large organizations, it's almost impossible to control everything centrally. Okay, because the companies start growing, there's a lot of complexity involved when companies start growing, and therefore they create responsibility centers in which each manager is responsible for that unit. When they do this, when they create responsibility centers, so when the company starts growing and starts creating these responsibility centers, we say that it is decentralizing. Okay, so this is the process of decentralizing. Why it is important to have responsibility centers? Because it allows or it enables accountability. Okay, because if there's no one responsible for that unit's performance, so if we only have the CEO responsible for everything, and obviously as the company starts growing, the CEO cannot handle an understanding, cannot manage everything by himself. And if there's no one else to help him in this task, then it can create problems in the management of the organization. That's why by having someone responsible for the units, it creates accountability. So we know that this person is responsible for that unit. If something goes wrong, if something goes well, we know that this person was involved. So this person, if it is something good, the person should be congratulated. If it's something bad, the person should be, punished or something. Now we have these 4 types of responsibility centers. We have cost centers, revenue centers, profit centers, and investment centers. Cost centers, the manager is only responsible for the costs of that unit. In revenue centers, the manager is only responsible for the revenues. In profit centers, the manager is responsible for both the costs and revenues, so the profit. And in investment centers, the manager, on top of being responsible for costs, revenues, is also responsible for investments. Okay? So when we think about a company, so for instance, we think about a manufacturing company, we can think of a cost center. Can be, for instance, the factory. Okay, the manufacturing manager is responsible for the factory, the costs incurred in the factory. When we think about a revenue center, can be, for instance, the sales department. So in the sales department, there is the sales manager that is responsible for the sales, and they only have a responsibility over the revenues, the sales. When you think about a profit center, can be, for instance, when you think about the example that I just gave you of the shopping mall with the different stores. So the manager of that store is responsible for both the costs and revenues of that store. And when we think about investment centers, is normally what we have at the higher levels of the hierarchy, like the CEO, who will be responsible for both the revenues, costs, and also investment decisions. Now, when we have these responsibility centers, it leads us to what we call the responsibility accounting. So responsibility accounting assigns differences from the targeted performance to the individual who is accountable for these responsibility centers. So if we have the manager of the store who is responsible for the revenues and the costs of that store, if something goes wrong, something goes extremely well, which was not expected, we know that this is due to this, is the responsibility of this manager. Okay? So responsibility accounting involves the setting of performance targets, and what we normally have. Let's, for instance, thinking about stores like Zara that sell clothes, and they have these targeted sales, okay, and target costs. So they have these performance targets, and they will do their best to achieve the sales targets. It also involves measuring of performance. Okay, we set performance targets, and obviously we have to measure. Okay, so if we have a sales target of 100,000, so we will then have to be measuring the sales revenues. Okay, so every month, how much is sales revenues, so that we can know if we achieve or not the target. We obviously will compare the performance against the target, and we will analyze the variances. If we will compare what was the actual sales revenues, what was the target, we'll compare, and normally there's differences, there's variance, and we will analyze where these differences come from. Okay, where the variance come from is because of the price was not as expected, the quantities is not as expected, was because of COVID, and there's a pandemic, we have to close the stores, and that's why the target was not achieved. And then taking remedial actions. Okay, so there's a crisis going on. What can we do instead? Okay, so like maybe we can sell online, or maybe we can increase our marketing efforts, or we can change the employees because the current employees, they're not very productive, or something else. Okay, so that is what responsibility accounting involves. And what do we need to take into account when we're talking about responsibility accounting? So obviously, one of the example that I gave you about, there is a pandemic and we could not achieve the sales. We can only blame the managers or put responsibility on the managers for things that they can control. And the pandemic that we are currently living on cannot be controlled by the managers of the store. And that is why it's important to distinguish between controllable and non-controllable factors. And we will talk about the controllability principle very soon. Okay? So it's very important that we can distinguish in which items, which factors can the manager control. So if he can control the employees, the performance of the employees, if he sees that an employee is very good, he should do the best effort to keep this employee working and happy. If he sees that this employee is not good, is just lazy, is rude to the clients, so he will probably he has that power, he has that responsibility, and he will just ask this employee to leave and hire a better employee or more capable employee for that specific job. So there are controllable and non-controllable factors. And we can only bring responsibility to the manager on those factors that he or she can control. And also we need to think about how challenging the targets should be. Because if we set a target of, say we want 1 million, maybe 1 million of sales revenues is not achievable. It does not make sense because it is a small shop. We sell, very few products with that. There's no way we can ever achieve 1 million sales with the product, with the size that we have. Okay, so we have to think about how challenging and realistic the targets are. And then also think about how much influence the managers should have in setting these targets. Okay, so are the targets, are the managers themselves that, make the expected targets? Or is someone else, is the CEO who sets the targets for each manager? So who is it? How much influence managers have in doing this? This is important because, and we will talk more about this in the future, if we have managers that they set their own targets, as you can imagine, they will set targets that are easily achievable. Okay, so if they think, okay, we can make sales of 500,000, but just to make sure that I get my bonus at the end of the year, that everything goes well, let me put it in 400,000. I'm pretty sure we can achieve the 500,000, but let me just put 400,000 to feel comfortable, to feel safe. So if the manager has this possibility to influence the target, he will most probably bring the targets down to make sure that he can achieve the targets. So it's important to have these, to think about how much influence the managers have. If if it's only the CEO putting targets in everyone, so let's imagine the CEO puts targets for every store, and the CEO doesn't have a very good idea of each store, the business, the environment, the complexity of each store, and just says, no, each store must sell 600,000. But maybe some stores will sell more, other stores will sell less, because in some stores they are in a shopping mall, which is larger, with more clients, more visible. In another stores, they're in a smaller shopping mall with fewer clients, so it has a less amount of business. And if the CEO just puts the target equal for everyone, it will be also unfair. So it's important to have here a fair contribution from both sides, making sure it's not too challenging and fair, or it's not too less challenging. Okay? So this is about responsibility accounting. Now, we talked about, when we talked on the previous slide, about this, that we should set targets, or we should measure those factors for which the manager has control. Okay? So it's not fair that we blame the manager for the pandemic, because he cannot control the pandemic. So this brings us to this concept of the controllability principle. So the controllability principle advocates that it is appropriate to charge to a responsibility center only those costs or revenues that can be influenced by the manager of the responsibility center. So we will distinguish between the controllable and non-controllable factors. So we have here some examples of uncontrollable factors, like the competitors' actions, supply shortages, acts of nature. We could consider this pandemic one of these uncontrollable factors. But applying the controllability principle is difficult in practice, because we have some categories of cost or revenues. It's not always black and white. You remember the first lesson? So it's there in a kind of a gray area. It's more or less controllable, but maybe it's also a little bit uncontrollable. For instance, let's imagine a car manufacturer. So we cannot control the competitors' actions, but we know there is a trend in the car business for cars to develop, more efficient, that cars like electronic cars and cars that, with specific features. Okay, so we have these hybrid electric cars, and let's imagine a car manufacturer that does not invest in anything in this type of cars. So what we will think about the manager? So, okay, the manager cannot control that the competition is launching these very efficient electric cars, which are cheaper than the others, But, okay, we cannot control that. But is general knowledge that the industry as a whole is moving towards electric cars, and they are investing in this side of the business, and we are not doing anything. Okay, so there is here, a kind of a gray area. Okay, we cannot control the competitors, but at the same time, we know that, everyone is doing that. So we had that knowledge, and we could also be doing something about that. So it's an example of a gray area. Obviously, when we talk about these kind of large investment decisions, it's not like the small manager that is responsible. It's more like at the level of the CEO. Maybe when you think about smaller components of the cars, maybe we'll have, a manager that is responsible for that. Okay. So when we have this kind of gray areas in controllable and non-controllable factors, what can organizations do to distinguish between these kind of factors? So what we want managers to focus is on those areas that they want the managers to pay attention to. Okay, there's a lot of factors that the manager can be responsible or not responsible, that can control or not. But we want the manager to focus on this. Okay, so we want the manager, let's see, go back to the example of the store in the shopping mall. We cannot control what the other stores in the shopping mall are selling. Okay, so we receive the products from centrally from the company. They deliver the products to our store here in the shopping mall, and there's a lot of other stores in the shopping mall. We cannot control what goes on in the other stores. We cannot control which products we receive because these are produced centrally. It's not me the manager who decides the design of the products. We will sell more shirts, or we'll sell shirts with flowers, or shirts with stripes, or white shirts. We cannot decide on the products that the brand offers. But if we see that other stores, they're selling a lot of this kind of product, I can choose, as the manager can choose to put on display this kind of other products. Okay, so they have a certain amount of flexibility on what they can do. And what we want managers to pay attention to is on this specific items. So we don't want managers to distract themselves with too many things, but we can say, no, this manager is responsible for the sales, and he will have responsibility on the products on display. Okay, so he will be focusing on having the best display possible, and we'll think that this will increase the sales given the circumstances that he is limited to. Any questions on this? No? So let's now distinguish between functional and divisionalized organization structures. So I'm pretty sure that you heard about this before. So in a functional structure, we have that the organization as a whole is an investment center. And then below this investment center, we have a functional structure. So there is the CEO that is responsible, and then we have the different departments of the organization. And what we have, on the other hand, divisionalized structure, in which we have the organization and with different divisions, and each division will be an investment or a profit center. So we will see a diagram next, just to visualize the difference between what is a functional structure what is a divisionalized structure. So normally when we have divisionalized structures, what is important to keep in mind is that these are related with decentralization, okay? So we have that the decision-making process is decentralized. So we have the managers because it's investment and profit centers, not just cost and revenue centers. We have this decision-making, and the decision-making is in the hands of the managers of each division. So it brings more interdependence. So we have here the functional organizational structure. So we have the CEO with an investment center, and below that we have like the production manager as a cost center, the marketing manager as a revenue center. So we have there some examples, and below these we have other functional managers. While on the individualized organizational structure, we also have the CEO, but then we have divisions, for instance, for each store or each product or each region. And then we have a manager that is responsible for this division. And this can be either an investment center or can be a profit center. Okay, so it has a higher level of responsibility for these managers. So advantages of divisionalization. It improves the quality of decisions. We have faster decisions because we have more managers that are taking the decisions, not just one CEO for everything. Have more, each division has a manager that is taking decisions. So we have improved quality because for each decision, the manager knows more about that division, okay? So he's better knowledgeable about what is going on, about the environment, about the challenges, so can make better decisions, and also faster because he has less responsibility than the CEO for the whole organization. It also increases the motivation of the manager because he's responsible for making the decisions. So this increases motivation and enables top management, the CEO of the organization, to devote more time to strategic issues. The disadvantages. So we might have here a question with goal congruence, because if we have the various managers of the various decisions taking decisions by themselves, if there's not a clear picture strategy in which every manager knows where the organization as a whole should go, they might not be taking decisions that are consistent with the strategy of the whole organization. And also it's more expensive to operate a divisionalized structure because we will have more costs associated with each division. While if we have a functional structure, we have the CEO, and then we have like the accounting. Accounting is the same for everyone. If we have a divisionalized structure, maybe we have a secretary for each manager, we'll have an accounting for each division, etc. And also it makes the top management to lose control on what's going on the operations. If there's not a good communication, top management might lose a little bit of control on what's going on. What is needed to have a successful divisionalization is, so first it makes sense to apply this divisionalized structure for those organizations that have diversified activities. Okay, so if we have a company that it produces the one or two products that are very similar, it probably doesn't make sense. But if you have very large company like Unilever has divisions. So in each country they have division there with when they make decisions in terms of products, in terms of production, in terms of investment, and they have it there. But because it's a huge organization, right? When you think about organizations that don't have that much diversified products and activities, have a smaller scale, so it might not make sense. And also, we need to make sure that in order to have a successful divisionalization, that divisions know what is their role and We don't want divisions to compete between themselves, right? We want the different divisions to work together for the organization as a whole. So there needs to be a clear strategy, a clear map of where the organization is going forward. So every manager should be aware of this and should be working towards the common goal of the organization. So this should be important when considering divisionalization. Now, when we talk about these different divisions, what we see very often is that we have divisions working for other divisions. Okay, so if we have, for instance, Unilever here in Portugal, and they have a factory to produce soap. And they also sell soap that they produce in Portugal to other divisions, the division in Spain, division in France. And they produce in Portugal and they sell to the other divisions. So we need to think about this transfer pricing. So what will be the price that we will transfer? Because if each division is an investment or a profit center, the division is responsible for both the revenues and the costs. And if the division is working for another division, is supplying a product or a service to another division, we have to think about transfer pricing, the price of transfer this product to the other division from the same company. Okay? So purposes of transfer pricing. So we want to have information that motivates the managers of each division to make good economic decisions. So we want to have the best for the organization as a whole. We want also to provide information that is useful to evaluate the economic performance of the divisions. And we want to intentionally move profits. We might want to intentionally move profits between divisions or locations. And when you think about these in terms of multinational organizations, they might want to move profits. Why? Who can tell why companies might want to move profits between different divisions or different locations?
Avoid taxes?
Exactly. Because in some places, in some locations, the tax rate on profit that company has to pay is much higher compared to other places. And if the company has division in each of these two places with very different tax rates, they might prefer to have more profits in the location where the tax rate is lower than in that location with a higher tax rate. And also we want to ensure that divisional autonomy is not undermined with this transfer pricing. So what is transfer pricing? The transfer price is the value that one division charges for a product or service supplied to another division, okay, of the same organization. The established transfer price is the cost of buying is a cost for the buying unit. So if we think about the company that is selling soap, produces the soap in Portugal and is selling to the unit in the division in Spain. So for the division in Spain that is purchasing the soap from Portugal, that is a cost. And for the division in Portugal that is selling the soap, that is a revenue. So the goods transferred from a supplying division to a receiving division are known as intermediate products. And the products sold by a receiving division to the outside world, okay, to the final client, these are known as final products. The objective of the receiving division is to subject the intermediate product to further processing before it's sold as a final product to the outside market. So let's imagine we produce the soap in Portugal, we sell to the division in Spain, but we'll sell in big containers. And then when we get to Spain, they will there pack in smaller containers and sell to the final client. So this is an example of the intermediate product and then the final product. So we have three methods of calculating transfer pricing. So we have the market-based transfer prices, cost-based transfer prices, and negotiated transfer prices. Market-based transfer prices are usually based on a listed price or market price. So this is the price that we see externally. Let's imagine that we sell the soap, and that there's a lot of other factories selling soap. So we can see what is the market price of the soap. So you normally compare the price that we have in-house with competition, okay? When we have perfectly competitive market for the intermediate product, the current market price is the most suitable basis to set the transfer price. And the transfer price here will motivate sound decisions to form a suitable basis for performance evaluation. Because here, if this is a competitive market, for the buying decision and also the division, and also for the selling division, it's the same to sell internally or externally. So they will set the price as market, the same as the market. Then we have cost-based transfer prices, when we have an imperfect or non-existent competitive market for the product, or if the selling unit has spare capacity. So if we are not working at full capacity, if we have capacity enough to produce extra units, and we can produce these units for the division of the same company, we will set the price based on cost. So we will use the variable cost, okay, or the full cost, or a cost plus a markup. Okay, so we have here these three alternatives. So we can either only charge the variable, the marginal cost, as the transfer price. We can charge the full cost, so it's including variable cost plus the fixed cost, or the cost plus a markup. So on top of the cost, we put a markup of 10%, for instance, to make a small profit. Or we can negotiate transfer prices. So these are more appropriate when we have market imperfections for the product and the managers have a bargaining power, the same bargaining power. So, for instance, if we were thinking about the previous example with cost-based transfer prices and the markup, maybe the purchasing division say, no, I don't want to pay this markup of 10%. That is huge. I won't pay that. And they will negotiate. Okay, if the buying division has this bargaining power. What is the general rule to set the transfer price? This is the general rule. Is the variable cost, okay, variable cost plus the opportunity cost, okay? Where the opportunity cost is the contribution margin that is foregone by supplying the unit to the division of the same company, okay, to this internal transfer of the product. So to set the transfer price, when we have a perfect competitive market, we take the general rule, variable cost plus the opportunity cost. So if we have a perfect competitive market, we could sell the product to the market, okay? And we would sell the product to the market at the market price. So we can just use the formula. So the variable cost plus the opportunity cost. The opportunity cost, if I choose to sell internally instead of selling to the external market, the opportunity cost is what is the contribution margin lost? What is the contribution margin lost by not selling to the external market? Is the market price minus the variable cost. This makes that the transfer price equals to the market price, okay? We take the general rule that we had in the previous slide, and we look at the opportunity cost in this case. On the next case, when we have spare capacity, so we have extra hours that we could be using, and they are not being used at the moment. So if we want to produce to sell to the other division, What is the opportunity cost? There is no opportunity cost because I'm not stopping to sell something because I have spare capacity. So the transfer price is the variable cost plus opportunity cost. But because I have spare capacity, I'm not losing anything. Remember, opportunity cost is the best alternative foregone to do something else. Because I'm not foregone doing something else. I don't have an opportunity cost here in this example. So that is why we can say when we have this case of temporary spare capacity, the transfer price is equal to the variable costs. Any questions before we move to the example? No. So let's go to this example. So we have here the details for division A. So we have a capacity of 50,000 units. We have the external selling price of 15 euros, variable cost of 8 euros, and fixed costs per unit based on the capacity of 50,000 of 5 euros. That means that the total fixed cost is 5 times 50,000. And we have division B, which wishes to purchase units from division A. As division B is currently buying 5,000 units per year in the market at 14 euros per unit. And they are asking what should be the transfer price. What should be the transfer price? So there's a capacity of 50,000. For division A, we have an external selling price, we have a variable cost, we have fixed costs, and division B wants to buy 5,000. They normally buy 5,000 from the market at 14 euros. And division A sells in the market at 15 euros. So who can comment here how to go about this example? So what are the assumptions that we need to do in order to solve this? So we have here Frederick saying the transfer price should be 5,000 times 8 since, so there's the assumption here on the since there is spare capacity. So that is an assumption. We don't know if there is spare capacity or not. Okay. If there is spare capacity, let's imagine there is a spare capacity of 10,000 units. If we have a spare capacity of 10,000 units, we can easily make these 5,000 units. And if we have spare capacity, the transfer price is equal to the variable costs. So that would be the 5,000 times the 8 that Frederick mentioned there. What if we do not have spare capacity? If division A doesn't have spare capacity, what would be the transfer price? If you go back to see the formulas, if there is no spare capacity,
It should be the 14 of the market price times the units.
Sorry, I couldn't follow.
It should be the market price times the 5,000 units.
So if we look at the general rule, is the variable cost plus the opportunity cost. If I don't have spare capacity, if division A does not have spare capacity, if they decide to sell to the other division, to division B, they will stop selling to the market. If they stop selling to the market, they will lose the contribution margin. And if we do the calculations, that would be the variable costs, 8 plus 15. Let's go there. 8 plus the 15 minus the contribution margin lost. 15 minus 8, which is the 15, the market price. Very good. And now so we have here the two options. So if we have spare capacity, the transfer price was 8. If we have no spare capacity, the transfer price is 15 per unit. Now on the third assumption, let's assume that division A has no spare capacity. But as a result of negotiation between the managers of the two divisions, €2 of variable cost per unit can be avoidable in internal sales. So let's imagine that, because it's the same company, we do not need to have this extra cost, for instance, with the transportation, because it's the same company. So we can save these €2 of transportation cost. In this example, we will reduce the variable costs from 8 to 6, the €2 of difference, and we will also include the opportunity cost, and we have here this negotiated transfer price. Okay? So here there was this negotiation. They reached this consensus of not having or reducing these variable costs because it's within the organization, and we have this negotiated transfer price. So it reduces the variable costs and we keep the same opportunity costs there. Any questions? No? So then we have international transfer pricing, which was the example we were just talking before in terms of taxes. So when we have divisions that are located in different countries, taxation implications become very important, and transfer price has the potential to ensure that most of the profits of these interdivisional transfers are allocated to the low taxation country. So we have here these examples. So we have the supplying division in country A with a tax rate of 25%. And we have the receiving division in country B with a tax rate of 40%. So motivation is to use the highest possible transfer price so the receiving division will have high costs and low profits, right? Because the receiving division B pays a lot of taxes. If the transfer price is lower, it means the profit will be higher, and therefore we'll pay more taxes. So we want to have a high transfer price. We want to have high costs for division B. So we want to have a higher transfer price in order to for optimizing the tax paid. Taxation authorities in most countries are wise, so obviously the government is not stupid and wants to avoid this kind of situations. So they know that companies try to use transfer prices to manipulate profits, and that's why we have these OECD guidelines based on these arm's length pricing principles. And you can read about that. You have there the web page on Moodle. So there are extra readings for week 3. Have a lot of extra readings there about transfer prices. We have there the page of OECD, and then you can go there to the list of countries. You can see the regulation of each country. So these guidelines based on these arm's length pricing principles. Okay, any questions? No, there's also a link there to an article from Strategic Finance. So you can see it on Moodle, and it has a good example with these international transfer pricing. So it shows there the example and the calculations of two divisions with different tax rates, and it shows the calculation step by step on the transfer price and the implication on profits and taxes. So that is also an important reading. It talks about other issues like planning and so on. You can also read, it's also very useful, but it's not directly related with transfer pricing. Only the first part of the article is related to transfer pricing. So what are the objectives of transfer pricing? So we have for domestic organizations is to have this greater autonomy between the divisions, to also increase motivation for managers, and to have a better performance evaluation and also a better goal congruence. To make sure that things are aligned within the organization. And when we have international divisions, the objective passes through to have less taxes, to pay less taxes, to have less foreign exchange risk, to have a better competitive position, and to have better governmental relations. So now we have an example. So this is problem 3. So we have this company with two divisions, A and B. Division A manufactures a product that is sold externally as well as transferred to Division B. Division B was contacted by the supplier, so it's an external supplier, the Blue Company, which proposes to sell 2,500 units of the same product manufactured by Division A at 35 euros each. So we have Division A that produces the product, and Division A sells externally and sells internally to B. And now B was contacted by someone from the external market to sell 2,500 units of this product at 35 euros. And now we have information on Division A. So Division A sells to Division B at 40 euros per unit. So it's important because the external supplier, this Blue Company, is offering 35 euros and Division B pays 40 euros to Division A. So they start thinking, okay, Division A is screwing me, so we can buy cheaper at the market. So they will think twice on this issue here. So Division A sells to Division B at 40 euros per unit, a total of 400, so we can calculate the quantities. And to the external market, it sells at 45 euros per unit, with a total of 270,000 of sales. We can also calculate the units there. Now we have variable cost of 22 euros per unit, and we have costs of 120,000 euros, and we have there the profit. Now, assuming that the external sales cannot be increased, measure the impact on the profit before taxes of both Division A and the company as a whole, if Division B decides to accept the proposal made by this Blue Company, the external one. So, if Division A stops selling to Division B, it will not be able to sell these units to the external market. So there is fixed demand on the external market. We cannot increase those sales. And if Division B decides to accept the offer from the Blue Company at 35, which apparently makes sense, because they are paying at 40 to Division A, so they prefer, Division B alone prefers to pay 35 than to pay 40. They want to decrease the costs. So we want to see what is the impact on profit for division A and the impact on profit for the company as a whole. So I will let you do these calculations. So couple minutes for you to try to calculate the profit, the impact on profit for division A and the impact on profit for division for the company as a whole. Okay? And when you have some numbers, let me know, or if you have any questions. So if we do the calculations, how many units are we talking about? So Blue Company is only proposing to sell 2,500 units. Okay, so this will be the impact, will be on these 2,500 units. So we have here Duarte with the answer of 32,500. Do you want to explain how you got this value, Duarte? So is this for division A? Is this for the company as a whole?
It's for the company. Division A will increase its profits by times $5 per unit, but the company will lose
wait. So division, you said division A will increase profits.
B.
Okay, so division B will increase profits of €5. The difference between the 40 that it used to pay to division A and the 35 that it will start paying, so we'll save €5 times the 2,500 units. Okay. Now, what is the impact on division A? So that was the impact on profit from division B, and that would give us 12,500. Now, the impact on division A.
The impact in division A is minus 55,000.
55,000?
No. I didn't make this way. I just thought that for the whole company, the cost will increase from 22 to 35 per unit, and made the calculation from there.
Okay, so can you explain the calculations for the 32,500?
So for each unit, I can't explain. I'm not very good at explaining things.
So the value is correct, but it's important that everyone knows how to get to the value, right?
Now each unit for the company is going to be bought at, or the cost for each unit is 35, and before was 22. So the difference in costs are 35 minus 22, and that's the loss in profits.
So let me see. Frederick saying that A loses 100,000. Why does A loses 100,000?
I actually got 45,000 for company A.
For division A?
Yeah, exactly. So what I did was I reduced the amount of units sold to division B.
So before in the table that we have here, how many units is A selling to B?
Now or before?
Now. And in the first before. So before the
So
special
before it's 10,000.
10,000. So the starting scenario, division A is selling 10,000 to division B at 40 euros. The blue company is proposing to sell only 2,500. Okay, so the impact will only be on the 2,500s. So you can continue explaining how to get to the 45,000.
So basically now division A will only sell 7,500 units to company B, to division B, and I assume that the external market will be the same. So now we get to sales. The total sales will be 570,000.
So the sales from division A will decrease in
100,000. And then for the variable costs, I also reduced the amount of the total units sold. So basically, if before we had 7,500 units sold to division B and 6,000 units sold to the external market. So now that times 22 will get me to 297,000 in terms of variable costs, and fixed costs I assume that will be the same. And thus the profits will get to 153,000 euros, which is less 45,000 than before.
Than the original scenario that we have there on the table. Anyone else wants to comment or say something or questions? No, so we could look at the impact. So Gonçalo, he was explaining, he was looking at the total, making the total, and then compare the impact on profit with the difference. We could just calculate the impact on division A. So for division A, they would have a reduced profit of 45,000, which would be the contribution margin lost on the 2,500 units that division B will stop purchasing from them. And division B will have savings of 12,500, as we talked before, of these €5 that they will save by purchasing 2,500 units from the blue company. And we can see for the company as a whole, we can just calculate the sum of both impacts. So for division A, we have a minus, so a negative impact. And for division B, we have a plus, a positive impact, because it's a saving. And it would give us a difference of 32,500. So while for division B, it would be very obvious. Obviously, I want to purchase from blue company. If they could sell 10,000 units, even better, because they're selling at a lower price than compared to what they are paying to division A. So they prefer to purchase from blue company. But you see that affects the company as a whole negatively. It will reduce the profit. The reduction in profit from division A is much higher than the savings from division B. What would you suggest in this case? If you were a consultant working for this company, what would be your suggestion?
Maybe a decrease in the transfer price.
Sorry, can you repeat?
Maybe a decrease in the transfer price.
Okay. So what kind of solution are you proposing? Negotiated transfer price, right? So they can negotiate. So the manager of division B, instead of first thing before anything, before the decision, he decides to purchase from Blue Company. If he talks to the CEO, if he talks to the manager of Division A, they will realize the company as a whole will be worse if Division B buys from the outside, and they can negotiate with the manager of Division B and say, look, I prefer to do this. If Division B is a profit center, the manager is responsible for the profits, and it will increase the profits if he purchases from the outside. And Division A, if it's also a profit center, the manager is also responsible for the profits and does not want to lose this much profit. So they can negotiate a transfer price. Very good suggestion. Anyone else wants to comment or ask any questions? No? So we are finishing. Before finishing, so just to remember, there is this webinar on the 25th of February on Zoom from IMA, so about a business partner. So if you want to have a career in this business area, I think is a very good opportunity for you. And then there is also another webinar on the 4th of March. I just got to know this yesterday. You remember I told you we have scholarship, the CMA scholarship. We have scholarships here at the school. If you want to become a certified management accountant, the scholarship provides the full tuition of the CMA exam and also resources for and the membership for EMA. So if you're interested in the scholarship, I suggest you to attend this webinar, okay? Because they will explain what are the benefits and about the process of the scholarship, okay? So this is a webinar on the 4th of March. And this is where you can register for this webinar. So for the business partner next week, you can just click the link. There's the link there in the picture. The slides are on Moodle, and then for the CMA, we also have the registration there with the link that you have there. Okay. Now I will just make available now on Moodle. There is a quiz. Okay, this quiz is a mandatory, so it's already visible there. It's almost visible when Moodle lets me make it visible. Okay. So there's this quiz here on Moodle. So the quiz is there under the mandatory activities. We have the quiz there is in relation to the first part of the class today. Okay, so the quiz is on relevant costs. You have 15 minutes to do the quiz. Okay, you can do it today. You have 15 minutes, but the quiz will not finish after the 15 minutes. Okay. So you have to control the time. If you decide to take longer than the 15 minutes, so if you're not well prepared and you take longer, what might happen is that we will adjust your grade downwards in percentage of the extra time that you take. So I advise you to prepare and then make the quiz within the 15 minutes so that you do not have a penalization on your grade of the quiz because you take longer. But this is a trade-off, like we saw on the first slide, benefits and costs. Okay, so it's 15 minutes, it's 10 multiple choice questions, and some of them are calculations. It's all about relevant costs. Okay, so I will just stay around for a few minutes. If you want to ask any questions, if you If you want to talk about anything, just stay around and we can chat. Otherwise,
Teacher,
I'll see you
sorry.
again next week. Yep.
Is there any deadline for the quiz?
Yeah, the deadline will be available throughout the weekend, but I would advise you to do it today.
Okay, thank you.
Any more questions?
I have a question, but it's from last class. It's because of the product and period costs. From what I understood, the product costs are related to inventory, and the period costs are the ones that are accounted for when they happen and not when the product is sold, right? So when we have the cost of goods manufactured, they're both because it's related to inventory, but it's also accounted for when the products are manufactured and not when they're sold. So are they period costs or product costs?
Okay, so the question, so all non-manufacturing costs are period costs. Okay, they go directly to the P&L when they are incurred. And then we have the manufacturing costs, and here's when it becomes a little bit tricky. So for the manufacturing costs, how we calculate the cost of goods manufactured. Now we calculate the cost of goods manufactured, but when we produce the products, if we don't sell the products stay in inventory as an asset. And if you visualize the company, if you visualize when we produce the products, the cost is attached to the product. If the product stays in inventory, is an asset in the balance sheet.
The cost of goods manufactured is before that, right?
No.
Cost of goods manufactured are accounted for when they happen. It doesn't matter if the product is when it started being produced.
So when we start producing the product, so think about the factory. We enter the factory, have all the machines, all the materials, all employees working there. So we have these costs, but these costs will be attached to the products. If the product is not finished, the cost will be, you will register as a work in progress, inventory of work in progress. Okay.
So is it product or period cost?
This is a product cost. Is a manufacturing is related, is attached to the product. Now when we sell the products, they leave the inventory, the warehouse, they go to the client, and we register on the P&L. So we only register these costs, these manufacturing costs on the P&L when we sell the products. Before that, we don't register these costs on the P&L.
But then it's not cost of good manufactured. When you sell it, it's not cost of good manufactured anymore, right?
When I sell, it's cost of goods sold.
Yeah, so okay, but I was asking about manufactured, so it's product because inventory. That's it, right?
Because there is no item on the P&L cost of goods manufactured. On the P&L, we only have cost of goods sold.
Yeah, okay.
So when we think about the materials, we don't register on the P&L by function. We don't register the materials, all the materials. We register the materials that were used in the production of the products that were sold. Okay. So because the others are in inventory.
Thank you.
Okay. Any other questions or comments? So Philippe here, yes, so the quiz is on the first part of the class, so on the relevant costs.
Professor, just a question. A professor said that the quiz will be during this weekend, so it will finish on Sunday, right?
Yes, so the quiz is available throughout from now until Sunday. Yeah.
Just because I check it and it says that is until Saturday, so.
Oh, it says until Saturday, so it's until Saturday.
Okay.
So, but it says there the time, so.
So just because professor said that, so I was just checking it if the professor will give more time.
Oh yes, there is Saturday there on the quiz. Yeah. Now I can give a little bit more time.
Thank you.
Until Sunday. Yeah. Anyone else? No, everyone else is good. Any questions?
Professor.
Yep.
I confused in example 7.
Example 7?
Yes, the relevant cost. We had the two options, right?
Let me go back to example 7. Okay, example 7. Yes, we have two options.
The first option would cost us 240,000.
So the first option, which was to subcontract the 4 specialized workers, it would the relevant cost would be 4 specialized workers times 60,000, which would give us 240,000.
So we forget the 10% manager's time, right?
Exactly. We do not consider the 10% because we are assuming that the manager was not doing anything for this time.
Okay, thank you.
Okay, and the second option was 172,500. 172,500.
Okay. Which was 4 times.
Which is the 22,500 plus 150,000.
Okay. You don't consider
We don't consider the salary of 45,000 of the employees because we are already paying this salary. We only consider the extra costs that we're going to have. So the costs that we already have, they do not change between the alternatives. The 45,000, they don't change. We already incur in the 45,000 euros, okay, independent of the choice. But because if we choose to train, what will be the extra cost? Well, if we choose this option, we will have an extra cost with the training, 22,500, and an extra cost with replacing the hiring new employees with a total cost of 150,000.
Okay. Now I understand. Thank you very much.
Good.
Okay. Thank you.
Okay, anyone else?
Sorry.
Anyone else who wants to comment or say something? No? Okay, so I will change the deadline on Moodle to Sunday evening, and I will finish the class today. Okay?
Thank you.
Okay, so I will see you again next week. Next week
Bye.
I'll give you information about the case. Okay, I will send you next week. The case will be available. The case study, the group case study will be available. So make sure that everyone has a group. And I will give more information and make the case available in the next few days. But I will send an email. So thank you very much. See you next week.
Bye-bye.
Bye.